morning, everybody. It is Thursday, January 26th. And we got to go backwards in order to look forwards today. But I want to start out with the spreads. Yesterday, those bullish puts, the aggressive 39.50, 39.45, which in the beginning of the morning prior to that big drop down, did look like it was going to be the safe trade, but the safe edges started to widen out. Safe edge on the bottom there being 39.22. Safe edge produced. You got a little bit better than 50 cents, a little bit better than 11%. And the risk trade closed out absolutely zero. On that, I'm going to go over that trade of the week, right? So I was getting a lot of messages about the trade of the week, and going backwards, going into the week 4 2023 forecast, I had posted it falling resistance line, falling below 4,000 now. That was what I was looking at for being aggressive. And where was it? As overbought as we ended Friday, I'd expect the dip to 39.20, 38.90 for Tuesday. I'd go as aggressive as thinking we don't even print 4,000s this week. And that was obviously blown out of the water on Monday. On Monday, I did post out the email prior to the open as well. All your highlights, blah, 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 blah. Then covering again and saying, thus, I'm looking for a revisit to last week lows this week, the minimum being 39.30, 39.20, and still having that forecast here on the chart. And yesterday, all we got down to was 39.49. That little dip right there. And a lot of you guys saw over in that was your posts here saying that the trade of the week was down to $1.60 right after the open. And then you had some dollar flashes. In the alert room, posting back up to that morning. Yeah, like I said early in the morning, we did everything that we wanted to do. We dipped. We got the 50 retrace. We got the 200-day moving average. We dipped below 39.50. We avoided 39.45. And we're back into the overnight gap. We already hit the 2022 resistance line. I'll check in. We'll see what's up. But, we did everything that we needed to do as far as the dip went. And guys that were in, or I'm sorry, he, she, they, them, that were in the trade of the week that decided to hang in there, did this.
Watch out! Watch out! Watch out!
And you see there, that's why I kind of got to go backwards to go forwards, because a lot of people fell into the greed trap. And greed. It's greed. It's mine. I want it all. It's all mine. I want all of it. And again, it's all about compounding. It's about calculating. If you're taking $25 on a $5 on one contract spread, and again, we're talking about 500 total here. You start compounding. You're making $25. You're up to another contract after 20 trades. You go in and you start compounding on 50 cents, and you're in the club. 50 cents, 10 trades, you're trading a second contract. You're already up. You're compounding. You're getting your trade. You're getting your profit level. You're out. You're moving on. You don't care what happened to everything else. Even here, I did this for somebody that was asking me a question. And if you were taking just $1, or not just $1 is great. You're getting $1 credit. You're trading two contracts after 5 trades, and you're compounding and like I did with that. Okay, let's say 100 contracts. That's the max. It's not the max. You can trade 500 contracts. I've done it, but let's just say 100 contracts. That's the maximum, and you're getting $1 on that. After week 31, you're trading 100 contracts every day. You're making 10 grand every week. It's 278 grand. And yeah, again, we've got a lot of things to work out into that. Like, what if you need to roll it? You need to have the margin. And, you're not going to be right all the time. Of course you're not. And then these are why you have that credit level that you're looking for. And you have your charts and you have your technicals and you have other eyeballs that are looking at this stuff. but you just can't be getting steamrolled into this, mentality that everybody has gotten into over the course of the last few years. It's all mine. I want it all. I want all of my credit. Now it doesn't work. So going to take you on to Tesla first. And you go back there into the YouTube channel, and a lot of you guys who were already here 2 weeks ago posted that email or that video of that Tesla whale. The guy put $95 million into one trade. And that trade is still highlighted here, and his open interest is still there. 25,000 contracts on the April 21 80 calls. This monster is up almost $100 million as of now. It's just amazing. But anyway, here you are, 50-day moving average. That was pretty highlight to see. And Elon came out with his, I've secured funding, 420, we're going private. That was what his conference call was, talking about how he's going to do 2 million cars next year while everybody's in credit card debt, credit defaults, mortgage rates are up, people are having problems getting to, their getting food on their table for a reasonable price, with the price of eggs, with the price of onions over here. And it's just a bunch of bullshit, the whole forecast for it. But regardless of that, don't care. Doesn't matter to me. You're up here. You're at 156. 165 was still my minimum level that I was looking for this to get to. I don't think it gets to it as of now. I'll show you why. Come on here onto the NQ, and here you are at the NQ. We're looking at a 30-day chart. This is going back to December, where we had that big spike up off that CPI, and that's where we're at. We're right at that same level, at that 12,000 cutoff line. 50-day moving average is the only thing I can show in this chart because the NASDAQ is such a complete piece of shit. But I want to see here so that you can see it, and you can see here how you've got a quasi cell divergence that you're running with here. So we'll see how it works, because we are here into Thursday. And here is the ES, the S&P. You can kind of see this trend line, but I really want to zoom in here and make aggressive attention to what we already talked about, how we are going to get that bullish crossover towards the end of the week, over the weekend, sometime during the course of next week. And that's why my entire focus has been getting a good dip, getting a good dip with a good oversold reading, which I never got yesterday, in order to go and get aggressively long to be able to have that bullish crossover, all the big tech names reporting, and the FOMC meeting coming the week after that. So still waiting on it. We're still above the 5-day, the 10-day, the 20-day, the 50-day, the 200-day, and the 100-day. But again, coming in here and zooming in, and how close we are getting to that bullish crossover on the S&P. And again, trying to quasi zoom in and just see what we've got on a shorter time frame. And we are fractionally playing around with a little bit of a cell divergence. So we'll see what we get. But again, this was the chart that I had posted there prior to the week, looking for that dip down to that green trend line zone, likely down to this 3908, back to the previous 2-week lows. Didn't get it. Only got here to that 39.49, and then yesterday they just shoved it down everybody's throat. Came back, filled the gap, and made sure to close red by just a couple of points. And on that just couple of points, we closed down 60 cents yesterday. We closed down 3 points the day before. But one of the things that I'm noticing here, and it's just me, it's got nothing to do with a table pounding alarm, but how we are now better than 10% below our year-over-year position where we were a year ago. And I've seen this come into play back here in December when we went up there to that 4,151 and we broke it, and then that caused that sell down. And I've seen it way back again over here in September, just prior to that big CPI spike, or sorry, that 41.19. And then that was the CPI report on the 13th, where we had the gap down and we dropped 177 points. It was right there again, same thing. And, here we bounced back up here in August, came greater than less than 10% from the year over year high lows or high, and we dropped again. So just something I've seen and I've noticed, because again, this is a video game. It has nothing to do with anyone's opinions, but I will bring this to the attention for, again, the wider view and as to why I'm really being patient, trying to get myself a nice oversold medium time frame, not the daily, just on the medium time frame, so that I can get back into a good strong calls position. And here you are on the SPX, fractional sell divergence on the daily. Daily is not a 1 minute chart, so this is a completely different time frame you're looking at. If you're out there doing 0 DTE, the daily doesn't mean anything to you. But you see here your trend line, which is the one that we keep talking about, the 2022 line. You can see here what is now the support line, coming here off the October lows and coming off the December lows. And we're in this little triangle zone right there. That little triangle as the 200 and the 50-day are getting ready to cross. We're right in that little triangle zone. And again, it helps to me to support my theory that I want to wait for a good dip. I want to wait for a good dip and get something down here closer to this lower trend line so that I can be a little bit more aggressive, and we'll have the energy to be able to come from here and just bam, pop right through that, all of this resistance that you see here at this 4100 level, and break through it to go into what I was showing you over there on the weekend. I am looking for us to be getting up here into the 4300s, even the 4500s. We're just not there as of right now. Come here onto the NDX, and it's even worse that you've got a pretty aggressive overbought sell divergence that's taken place over on the daily. And again, you've got your big 2022 line. You're greater than 30% from the all-time highs when you're below that 286 on QQQ. You don't really have a strong support level down here other than this 11,000 low from back here in June, which has been broken several times in October, in November, in December. And here we are going into earnings as we're in this resistance zone. So again, for me, it's not something that I'm being overly aggressive in any way, shape, or form on the call side, on the put side. We made good money on the puts. Had to wait a day or two before we could actually take on it. We got it. We got out yesterday. As for those SPX calls, the trade of the week spread, again, getting a $2 credit, a $3 credit, being able to get $1 credit for an exit is, again, one of those things where it's got to become a little bit religious that you're very happy with it. Like I said, the previous weeks, they've all closed worthless. I still have a tad bit of optimism that we could be closing below 4,000 and possibly even below 39.78, which I would prefer because I would like 2 red weeks. But we're not going to know about that until we get closer to the opening bell, because today at 8:30, we've got the initial jobless claims, we've got the GDP Q-on-Q advance, durable goods, and then we get new home sales. We have absolutely nothing but consumer spending and PCE tomorrow. Michigan sentiment, the final, which is again tomorrow. We got nothing going on. So, the reports for the week are done. Microsoft is done. To see Microsoft come out and give lower guidance and then take off running, to see Shopify where it is and then somebody come out and say, yeah, because prices are going up, Shopify is probably going to be they're going to do pretty good. And see Shopify go up 2.5% in a day. There's something else going on behind the scenes. And those who are exposed in a large way are going to wind up being those trolls that are walking like human zombies, and you're just going to get run over. So money's on the table. Take the money. See you guys in the chat room.